One of the most important financial decisions you will make in retirement has almost nothing to do with which stocks or funds you own. It has to do with the order in which you take money out of your different accounts. Most people treat this as a minor, practical question. They look at which account is easiest to access, which one has the largest balance, or which one their old advisor told them to use first. That approach feels reasonable. It is also one of the most expensive habits a retiree can develop. The sequence in which you withdraw money can easily change your lifetime tax bill by tens of thousands of dollars, and in many cases by more than $100,000. The difference does not come from finding a secret loophole. It comes from understanding how each type of account is taxed and then deliberately choosing which one to use in each phase of retirement. To understand why the order matters so much, we need to go back to the three main types of accounts and how the tax system treats them. Traditional IRAs and traditional 401ks are tax-deferred. You received a tax deduction when the money went in. The investments grew without being taxed each year. But when the money comes out, every single dollar is taxed as ordinary income. There is no preferential rate. A withdrawal from a traditional IRA is taxed the same way your salary was taxed while you were working. These accounts also carry required minimum distributions beginning at a certain age, which means the government will eventually force money out whether you need it or not. Roth IRAs and Roth 401ks work in the opposite way. You already paid tax on the contributions. As long as you follow the rules, qualified withdrawals are completely tax-free at the federal level, and in most states they are tax-free as well. There are no required minimum distributions for the original owner of a Roth IRA. The money can continue growing tax-free for as long as you live. Taxable brokerage accounts are different again. These are regular investment accounts funded with money that has already been taxed. You pay tax only on the growth, dividends, and capital gains. Long-term capital gains are taxed at lower rates than ordinary income, and in some years it is even possible to realize gains at a 0% federal rate if your taxable income stays low enough. You also have complete flexibility. There are no early withdrawal penalties and no required distributions. You can take money whenever you want. These three different tax treatments create the opportunity and the danger of withdrawal sequencing. When you take money from a traditional account, you create ordinary taxable income. When you take money from a Roth account, you create no taxable income. When you take money from a taxable account, you create taxable income only to the extent of the gains. The order in which you combine these sources determines how much total tax you pay, how much of your Social Security becomes taxable, and whether you cross IRMAA thresholds that raise your Medicare premiums. Many people have heard a simple rule of thumb: spend taxable accounts first, then traditional accounts, then Roth accounts. There is some logic behind this advice. Using taxable accounts first allows the tax-advantaged accounts to keep growing. Leaving Roth accounts until last preserves the most flexible. Once required minimum distributions begin, the situation changes. You no longer have complete freedom. The IRS requires you to withdraw a specific percentage of your traditional retirement accounts each year. That amount is taxed as ordinary income whether you need the money or not. After you have satisfied the RMD, any additional spending should generally come from the most tax-efficient source available. For many people that means turning next to the taxable account, especially to positions with little or no embedded gain, or even to tax loss harvesting opportunities. Roth accounts are often left until later because they continue to compound tax-free and because they provide the greatest flexibility if large unexpected expenses appear or if you want to leave money to heirs. This sequence, thoughtful use of taxable accounts and conversions before RMDs, then RMDs first once they begin, followed by taxable and then Roth, is a solid default for many households. It is not, however, a rigid formula that applies to every person in every year. Several important factors can justify changes. If you expect to be in a significantly higher tax bracket later, accelerating traditional withdrawals or conversions while you are still in a lower bracket can make sense. If you are already in a high bracket and have large unrealized capital gains, you may want to be more restrained with taxable account sales. If you have strong charitable intentions, qualified charitable distributions from an IRA after age 70.5 can effectively turn traditional account money into tax-free gifts, which changes the optimal order. If you have a shorter life expectancy or high current medical costs, the value of long-term tax-free growth in a Roth may be lower, and using traditional money sooner may be more appropriate. Legacy goals also matter. People who intend to leave substantial assets to children or grandchildren often prefer to preserve Roth accounts because heirs receive them tax-free under current rules. The interaction with Social Security is especially important. The more ordinary taxable income you create from traditional account withdrawals, the more likely you are to make a larger portion of your Social Security benefits taxable. Up to 85% of Social Security can become subject to federal income tax. A withdrawal sequence that ignores this interaction can produce a cascading effect. Higher traditional withdrawals create higher taxable Social Security, which further increases your tax bill. Managing the order of withdrawals is one of the main tools for keeping Social Security taxation under control. Medicare premiums introduce another constraint. IRMAA surcharges are based on your income from 2 years earlier. Crossing an IRMAA threshold can raise your Part B and Part D premiums by a meaningful amount for an entire year. Because the brackets are not extremely high, even a moderate increase in taxable income from traditional withdrawals or large capital gains can push someone into a higher IRMAA tier. A careful withdrawal sequence tries to stay aware of these cliffs and avoid unnecessary crossings when the cost outweighs the benefit. To make this concrete, consider a simplified example. A couple retires at 65. They need $85,000 a year to maintain their lifestyle. Social Security will eventually provide $42,000. They have $1.1 million in traditional IRAs, $300,000 in Roth accounts, and $400,000 in taxable brokerage accounts. In the first several years they take most of their spending from the taxable account while realizing long-term gains carefully. At the same time they convert enough each year from the traditional IRA to fill the remaining room in the 22% tax bracket, paying the tax from the taxable account. Over 7 or 8 years they move a substantial amount into the Roth. When RMDs begin, the traditional balance is noticeably smaller than it would have been, the required withdrawals are lower, and a larger share of their portfolio is now tax-free. The cumulative tax savings over their retirement can easily reach 6 figures compared with the strategy of simply draining one account after another without planning. The opposite approach, taking large traditional withdrawals early because the account is large and familiar, or spending the Roth early because it feels free, often produces higher lifetime taxes and less flexibility later. The difference is not always obvious in any single year. It appears gradually as RMDs grow, as more Social Security becomes taxable, and as the tax-free portion of the portfolio remains smaller than it could have been. There is also a psychological dimension to withdrawal order. Many people feel uncomfortable spending taxable accounts first because they like seeing a large investment balance. Others feel reluctant to pay tax on conversions even when the long-term math is favorable. Some become so focused on minimizing this year's tax that they create much larger problems in future years. A good withdrawal sequence requires looking beyond the current year and accepting that a moderate tax bill today can be the price of a lower and more stable tax bill for the rest of retirement. A practical way to implement this thinking is to review your situation once a year. Look at your expected spending need. Look at your guaranteed income sources. Calculate the gap that must come from the portfolio. Then examine your current tax bracket and the room remaining in it. Decide whether that room is best used for a Roth conversion, for realizing capital gains, or left unused. After RMDs begin, take the required amount first and then fill additional needs from the most efficient remaining source. Stay aware of IRMAA thresholds and the taxation of Social Security. Adjust when your health, family situation, or tax laws change. You do not need perfect predictions to benefit from this approach. You only need to stop treating all accounts as interchangeable and start treating the order of withdrawals as a deliberate decision. The accounts are tools with different tax characteristics. Using the right tool at the right time is what separates a tax-efficient retirement from an unnecessarily expensive one. The best withdrawal order is not a single fixed sequence written in a textbook. It is a flexible logic that prioritizes control over taxable income, especially in the years before and after RMDs begin. When you follow that logic, you keep more of your money working for you, reduce the risk of unpleasant tax surprises, and preserve greater options for the later decades of retirement. When you ignore it, the tax system quietly takes more than it needs to, year after year, without any single dramatic event to alert you. This is why withdrawal order ranks among the highest leverage decisions available to retirees. It does not require exotic investments or aggressive risk. It requires understanding the three types of accounts and then choosing, with intention, which one to use as each year unfolds. That single habit, repeated over a long retirement, is one of the most reliable ways to pay less tax without taking unnecessary risks.